let's turn to sentiment, Matt.
All right.
Sentiment's not looking good. Whether it's consumer, whether it's investor, domestic, or international, sentiment has taken a turn for the worse.
Yeah.
And so we have the most recent U.S. Consumer Confidence survey from the Conference Board. Confidence absolutely plunged in April. Post Liberation Day, the data is in, and it's not good at all. We're talking about a drop almost akin to levels that we saw last during the pandemic. Now, we weren't at a point, we didn't fall from as high of position prior to the pandemic. We kind of reverted to the mean. But man, basically since the beginning of the year, it is a very stark drop off. Basically, we were kind of in that mid, 110-ish range. Now we're down to 90 or so. It's not good. Not as low as it was pre or during the financial crisis. But we also kind of started at a similar place prior. So,
yeah, it's also notable that this is this downturn is several months in development. Especially the expectations, it's been going down for at least, this is not the first month that it started to plunge. It was going down for the months that preceded it.
And really since interest rates started hiking, or the Fed announced that they were going to start hiking interest rates, that was really the turn. I mean, we saw kind of peak confidence, kind of the period of still in COVID, but getting out of it, but before interest rates were started to be hiked, there was a lot of exuberance of we're just okay, soft landing, we're getting out of this COVID thing, everybody's making money, things are good, and then things started getting a little bit more expensive, and the Fed had to take some action. But apparently, it was not a transitory inflationary situation, although it was just not as short of a transient as some folks would like to have seen. Looking at families' current financial situation, talking about is it good, is it bad? Well, it's getting less good and it's getting more bad. The bad is up to kind of a 23-ish, up from kind of a 18. I'm kind of reading in between the numbers here. And then the good has declined, kind of peaking 31. Now it is kind of 24 on their scale of percentage of folks, their opinion of their own family situation.
For both current and expected, the family's financial situation is going down, and that was not necessarily an outlier, but among the entire report, the sense was, all right, things are okay now. It's a shaky kind of okay, but things are okay, not going down dramatically. But then their expectations 6 months hence is they went down on almost every category, but except when it comes to the labor market, there was also a decline in both categories.
And of course, Matt, we've got to look at the perceived likelihood of a U.S. recession over the next 12 months. And this is critically important because, our perception of what we perceive certainly can turn into reality.
Yeah.
And we can will a recession into existence quite easily. And we're already seeing a lot of that behavior, regardless of how the underlying fundamentals actually turn out, regardless of how tariffs and trade and interest rates actually end up working out, or inflation. If we want a recession, we'll stop spending money. We will stop spending on goods and services. And we're already seeing that happen. Vegas, again, anecdotes Las Vegas bookings are way down. Travel is way down. We've had companies that are starting to pull their earnings estimates, right now. Pulling back on spending. Businesses are more reluctant to hire, and families are more reluctant to make large financial decisions. And so just that in itself, and the anticipation of the bad times to come, could bring the bad times on themselves.
Yeah, it's interesting to see how that it was similar. It was a little bit higher actually in about May of 2023, and I'm wondering why.
I can tell you why. They read our loan maturity report. But I mean, this had started shifting basically as interest rates were rising.
Yeah.
We were talking about at the end of 22, really beginning of 2023 was the Fed was going to hike interest rates to rein in the labor market, to purposely cause a recession, to bring inflation in check. And we didn't really have that full recession, although we did have 2 negative quarters of GDP growth, but technically it wasn't a recession because other reasons. Right. But now, it's back up there, not for interest rates, because I mean the 10-year has basically been hanging out right around kind of 4.2-ish% in a range of call it 4.2 to 4.5 maybe someday. Okay. Fed funds rate, obviously the Federal Reserve hasn't lowered rates yet, but Fed funds futures have been coming down with the idea that this slower growth could potentially lead to a recession and force the Fed to bring Fed funds down even lower. But again, further complicating is this idea that tariffs and a trade war may be much more inflationary. And so then do we enter a real stagflationary environment where we have high inflation, but growth is really slowing down? And the textbook response to a stagflationary environment developed by Paul Volcker is to increase the Fed funds rate. Yeah. So that would not be fun for anyone. We saw last time that happened. It basically everyone thought it was going to put us into a recession. And it certainly is not going to help out CRE borrowers who are looking for a reprieve from loans at the current state they cannot pay back.
Oh, yeah. Very true. It's worth seeing how all of this consumer confidence plays into the perspective of renters, but it's also, it's a powerful sign of what investors might think. And it follows on the very same causes that are shaping the debt market in commercial real estate. True. It may not, consumers may not know specifically what's moving it, but the aggregate is, it follows, it's very highly correlated, it would seem.